The hidden safety net. Why bonds outshine stocks for the risk-averse. Imagine waking up to find your retirement savings slashed by 30% overnight. For many stock-heavy investors, this nightmare became reality during recent market crashes. But what if there was a way to sleep soundly, knowing your investments were shielded from such volatility? Enter the world of bonds, the unsung heroes of risk-averse investing. In the ever-shifting landscape of financial markets, conventional wisdom often touts stocks as the golden ticket to wealth. Yet for the risk-averse investor, a less glamorous but potentially more suitable option lurks in the shadows: bonds. As market volatility reaches fever pitch and economic uncertainties loom, bonds are emerging as an unexpected hero in the quest for financial stability. The allure of predictability. Picture a world where your investments behave like a metronome, ticking steadily regardless of market storms. This is the realm of bonds. Unlike their more capricious cousins, stocks bonds offer a predictable stream of income through regular interest payments.
After watching my stock portfolio roller coaster through the pandemic, I needed something more stable. Bonds gave me that peace of mind. I know exactly what I'm getting and when.
Actionable tip. Consider allocating a portion of your portfolio to high-quality government bonds for steady, predictable income. The risk-reward balancing act. At the heart of the bonds versus stocks debate lies a fundamental question. How much risk are you willing to stomach for potential returns? Stocks, with their siren song of high returns, come packaged with a hefty dose of volatility. Bonds, on the other hand, offer a more modest but consistent return profile.
Risk-averse investors often underestimate the psychological toll of market volatility. The steady nature of bond returns can actually lead to better long-term outcomes for these individuals, as they're less likely to make panic-driven decisions.
Actionable tip. Assess your risk tolerance honestly. If market swings keep you up at night, consider increasing your bond allocation. The diversification advantage. In the world of investments, putting all your eggs in one basket is a recipe for disaster. Bonds shine as a diversification tool, often moving inversely to stocks during market downturns. This negative correlation can act as a cushion, softening the blow when stock markets tumble. Let's examine a hypothetical portfolio scenario.
Portfolio A, 100% stocks. Portfolio B, 60% stocks, 40% bonds. During the 2008 financial crisis, Portfolio A, 100% S&P 500, saw a negative 37% return. Portfolio B, with 60% S&P 500 and 40% US Aggregate Bond Index, experienced a negative 13% return.
While both portfolios experienced losses, the bond-inclusive Portfolio B significantly mitigated the damage. This pattern has repeated itself in subsequent market crashes, including the COVID-19 sell-off in March 2020, where a similar bond-inclusive portfolio would have protected investors from the worst of the downturn. Actionable tip. Consider a balanced approach. Even a 20 to 30% allocation to bonds can significantly reduce portfolio volatility. Types of bonds. A spectrum of safety and yield. Bonds come in various flavors, each offering a different balance of safety and potential returns. Treasury bonds. Issued by the United States government, these are considered the safest investments but offer lower yields. Municipal bonds. Issued by state and local governments, they offer tax advantages but slightly higher risk than treasuries. Corporate bonds. Issued by companies, they offer higher yields but come with increased risk. High yield or junk bonds. These offer the highest yields but also the highest risk among bonds. Actionable tip. Start with safer treasury or high-grade corporate bonds. As you become more comfortable, you can explore higher-yielding options. The inflation hedge you didn't know you needed. In an era of rising inflation concerns, certain types of bonds offer a unique advantage. Treasury inflation-protected securities, or TIPS, adjust their principal value based on changes in the consumer price index, providing a direct hedge against inflation.
For retirees or those nearing retirement, TIPS can be a crucial component of a fixed income portfolio. They offer protection against the erosion of purchasing power, a key concern for those living on a fixed income.
Actionable tip. Consider allocating a portion of your bond holdings to TIPS, especially if you're concerned about long-term inflation risks. The liquidity factor. While stocks are often praised for their liquidity, many investors overlook the fact that high-quality bonds, particularly government securities, offer comparable ease of trading. This liquidity can be crucial during times of financial stress when the ability to quickly convert assets to cash becomes paramount. Actionable tip: keep a portion of your bond portfolio in highly liquid Treasury bonds for peace of mind and financial flexibility. A shield against market irrationality. One often overlooked advantage of bonds is their immunity to the kind of irrational exuberance that can inflate stock bubbles. Bond valuations are typically more closely tied to fundamental factors like interest rates and credit quality, making them less susceptible to the herd mentality that can drive stock prices to unsustainable levels. Actionable tip: use bonds as a stabilizing force in your portfolio, especially during times of market euphoria when stock valuations seem detached from reality. Addressing potential drawbacks. While bonds offer numerous advantages for risk-averse investors, it's important to acknowledge their limitations. 1. Limited upside. Bonds typically don't offer the growth potential of stocks, especially during bull markets. 2. Interest rate risk. When interest rates rise, existing bond prices tend to fall. 3. Inflation risk. For most bonds, high inflation can erode the real value of your returns. However, these drawbacks can be mitigated through careful selection and portfolio construction. For instance, using a ladder strategy, buying bonds with staggered maturity dates, can help manage interest rate risk. The bottom line: a case for bonds. As we navigate an increasingly uncertain economic landscape, the case for bonds in a risk-averse investor's portfolio has never been stronger. While they may lack the glamour of high-flying tech stocks or the excitement of cryptocurrency, bonds offer a crucial foundation of stability and predictability. However, it's important to note that not all bonds are created equal. From ultra-safe Treasury securities to higher-yielding corporate bonds, the bond market offers a spectrum of risk and return profiles. The key is to align your bond investments with your personal risk tolerance and financial goals.
The essence of investment management is the management of risks, not the management of returns.
For the risk-averse investor, bonds may just be the unsung hero in that quest for managed risk. In a world obsessed with chasing returns, sometimes the wisest move is to step back and appreciate the quiet strength of a well-constructed bond portfolio. It may not make for exciting dinner party conversation, but when market storms hit, you'll be glad for the sturdy shelter bonds provide.